Okay. Hi, everyone, and welcome to our webinar on unlocking the power of tax loss harvesting with direct indexing. I'm Carrie Quinn, Head of Index Solutions here at AlphaThena, and I'll be your moderator today. We're excited to be co-hosting this conversation with MainStreet Advisors, a firm that truly shares our passion for innovation and tax awareness. I've had the pleasure of collaborating with their team, and I'm confident that you're going to gain some insightful and valuable things from our expert guests today. Just a few quick housekeeping items that would be greatly appreciated. If you guys could mute yourselves, that would be great. In addition, we are recording this session, so you will get this recording afterwards. So what is on today's agenda on what we'll be discussing? Just a quick look at what we're covering. We'll be discussing how to identify ideal accounts for direct indexing, the advantages of utilizing DI and tax loss harvesting, real use cases for implementation from real portfolio managers, key benefits of utilizing the AlphaThena's platform, and then finally insights and from industry leaders from MainStreet Advisors, Bruce Simpson and Logan Clark. So to kick things off, who is AlphaThena and what is our mission? And our mission at AlphaThena, we help transform advisors and portfolio managers to create real value within their accounts. So we're a direct indexing platform that empower you to deliver personalization, tax efficiency, and portfolios at scale without those traditional headaches and being in spreadsheets or manual work that needs to be done. So what makes our approach different? We're a B2B platform utilizing API infrastructure. We enable tax loss harvesting real time, along with real-time customizations, and we have smooth transitions for portfolios that have legacy holdings. You can utilize the platform to transition this over smoothly. By connecting directly to your custodian and leveraging our AI personalization, we help RIAs, TAMs, fintech platforms, and wealth managers to focus on what really matters, which is their clients. And now I would like to I'm excited to introduce you to our experts at MainStreet Advisors. Bruce, who brings 15 years of experience within the industry, and Logan, who offers a new perspective as a recently minted CFA holder. Bruce, can you tell us a little bit about your background and what kind of accounts are good candidates for direct indexing?
Sure, Carrie. I'd like to thank everybody for giving us some of your time today, and really hopeful that we can provide some useful info that you can take things away. So my background, it's in equity research and wealth management, having worked at William Blair here in Chicago and Geneva Investment Advisors for 15 years before joining MainStreet Advisors as a PM in 2014. I hold the CFA and CFP designations. So Carrie, to answer your question, the accounts most likely to benefit from direct indexing or DI, they're larger taxable accounts held by performance-sensitive investors in higher tax brackets. DI accounts are also valuable to both individual and institutional investors looking to personalize their portfolios to have input on holdings that are matching their values or other specific criteria. Accounts with high unrealized gains, those closer to the distribution phase, or with concentrated positions, or they're going to see more tangible benefit from tax loss harvesting than those owned by investors just getting started in their account growth.
So let's take a common scenario. What if somebody holds a legacy position, maybe like Microsoft, right? And they work for Microsoft and they have a significant unrealized gain. They might be an ideal candidate for direct indexing if they're looking to gradually reduce that exposure in more of a tax-aware strategy. But direct indexing isn't just for individuals, right? So even institutions investors like universities, endowment plans, they might not benefit from the overall tax for tax loss harvesting, but due to their tax exempt status, but the customization seems to be useful for them as well. So it could be incredibly useful for their investment policies. So if they have to follow an investment policy guideline to avoid those sin stocks or type of business activities such as tobacco, alcohol, or fossil fuels, this would in line with their stakeholders' expectations. Would you say that this flexibility, whether for tax efficient or mission driven investing, is sort of what makes direct indexing so versatile as an overall solution?
Yeah, I'd say direct indexing delivers a number of benefits. Passive, index-based investing, tracking a benchmark, that's one thing. Personalization by the account owner to include or exclude securities or sectors. And then what this webinar is going to focus on today, tax loss harvesting.
Yeah. Logan, can you tell us a little bit about your background and your perspective on the advantages for tax loss harvesting?
Sure. I graduated from the University of Missouri about 4 years ago, after which I served as a research analyst at a small RIA in Columbia, Missouri. And then about 2 years ago, moved up to Chicago, where I've been serving as a portfolio analyst with MainStreet Advisors ever since. And as you alluded to earlier, I did just recently get the CFA designation.
Congratulations.
The biggest advantage of tax loss harvesting, in my view, is the ability to reduce your client's annual tax bill while not significantly changing the overall exposures of the portfolio. Investors often forget about taxes when it comes to net return, but it can be a bigger portion of expenses than management fees or trading costs, especially today in the current environment. By taking advantage of tax loss harvesting, an advisor can maximize after-tax return and generate what is called tax alpha in the process. So tax alpha is the additional return achieved by taking advantage of losses within a portfolio. Studies have shown that utilizing tax advantage strategies like direct indexing and Alpha Theta can yield as much as an extra 100 basis points per year in annual return.
Tax loss harvesting, like you said, has been around for years, but it's experiencing some resurgence due to automation and more accessible for direct indexing solutions.
I think you checked the private chat. It looks like Josh had a comment.
From an industry perspective, why do you think tax loss harvesting is such a relevant strategy, especially now?
So tax loss harvesting has gained more relevance in recent years due to several shifts in the asset management industry. Technological advancements are number one. So as we all know, the advent of AI has really changed how we do all sorts of work. But it's really improved the ability of investors to identify harvesting opportunities and find optimal replacements, all while managing tracking error to the direct index being tracked. Number two is reduced trading costs. Over time, trading costs have decreased, as we all know, making the frequent trading required by direct indexing and tax loss harvesting strategies more accessible to the average investor. Low trading costs it does enable the ability to achieve tax alpha, as I mentioned earlier. And then number three is the shift to passive management. Investors have increasingly been in favor of passive management over active in recent years. And in fact, the AUM of passively managed assets is now higher than active managed assets. There is still a strong demand for individual securities within a portfolio over just utilizing standard ETFs. So direct indexing kind of allows that customization component and tax advantages of holding individual securities while also aligning with the general trend towards passive management.
So as you said, Logan, direct indexing has revolutionized the way for portfolio managers and advisors. And unlike traditional mutual funds or ETFs, which offer a one-size-fit-all approach, direct indexing allows more of that ownership of those securities. It's not a one-size-fits-all. You can cater it and structure it for tailoring it towards portfolios that align for users' personal values, financial goals, and tax situations. And at Alpha Theta, we empower advisors to harness this flexibility. We offer the tools to customize those portfolios, a vast array of over 1,200 ETFs to choose from. And you can integrate with more factors and ESG. MainStreet Advisors has effectively utilized these capabilities by developing a suite of 8 direct index models, each tailored to their specific investments themes. Bruce, could you share your insights on how these direct indexing strategies fit into a broader market, into a broader portfolio construction?
Yeah, sure. For advisors who don't want to do the process of managing DI themselves, MainStreet Advisors has created these 8 direct indexes across different market caps and sectors and styles. They're shown on the screen. Whether the advisor chooses DIY or enlisting MainStreet as their partner, either way, AlphaThena technology is going to power the direct indexing engine and the tax loss harvesting behind it. So most DI strategies are passive portfolios of large cap stocks. Therefore, a DI portfolio is a specific type of SMA. And investors can use a DI SMA in place of higher cost active strategies, especially in large cap where the market's very liquid and very efficient. The 8 that you show on your screen there, Carrie, they're discretionary passive accounts, $500,000 minimum account size. Clients have the option to fund a DI account either with cash or in-kind securities. And if it's in-kind, the transition period to the targeted index can be specified up front. DI doesn't replace the need to diversify across or within an asset class. And in fact, it's inherently undiversified. But these DI accounts can be your client's standalone account at MainStreet, or they can be the large cap equity account allocation to a diversified portfolio. For instance, a DI account can accompany a second account holding bonds or funds. Now, the S&P 500 course is the most common index investors choose to track. They can also pick an index that tracks a different cap or a sector or style. For example, they may want exposure to QQQ, or they may want exposure to a dividend-heavy index. AlphaThena gives them that personalization ability to include or exclude certain securities. We could, for an example, easy to build an index that, say, tracks S&P 500, but excludes, Apple and McDonald's, if those are the employers of the account owner and their spouse, for example, or to exclude energy and healthcare stocks because the owner feels that those sectors will be a poor investing class over the next several years, or for the index just to overweight a particular style like momentum, for example. Tracking error is a key metric when you're replicating any kind of index. So tracking error, it's a standard deviation of the difference between the benchmark's performance and your account's performance. So a lower tracking error is good. That means you're more successfully duplicating the performance of the index that you're tracking.
Now, Logan, I know there's a big difference between understanding the concept of tax loss harvesting and actually implementing it well. So there's theory and then there's practice, right? So when it comes to scaling, timing, and trading logistics, from your perspective, what are the operational best practices that have helped your firm successfully integrate tax loss harvesting into your investment processes?
Yeah, number one, advisors need to set their parameters that they're comfortable with regarding a threshold for minimum unrealized losses that will trigger a tax loss harvesting trade. You may have losses across the portfolio, but is a $50 loss really going to be worth it for the client in terms of factoring in the transaction costs and the time spent to realize that loss? That's something the advisor ultimately has to decide. There are numerous settings an advisor can select, but specifying that minimum loss that triggers a potential tax loss harvesting trade is likely the most important. AlphaThena makes it really easy to set the minimum dollar amount, or if you prefer percentages, you can use that as well for the system to then turn around and suggest tax loss harvesting trades. Another decision an advisor needs to make is rebalancing frequency. So are you going to rebalance quarterly, monthly, annually even? There are obviously trade-offs to doing both. The more often you rebalance, the higher your trading costs are going to be. The less frequent, rather, that you rebalance, the higher your tracking error is going to be against the underlying index. Second, it's extremely important to be mindful of the wash sale rule. So Alpha Theta helps track the wash sale rule, so you don't inadvertently transact in a security that was sold for a loss in the last 30 days. If you're tax loss harvesting frequently, it can become quite unruly to keep track of trade dates that are relevant for swapping back into stocks that were sold for a loss. Alpha Theta also can tag together household accounts to avoid wash sale rules mishaps. So think you sell Apple in your taxable account, you can't buy that back in your IRA. So Alpha Theta does a really good job of keeping those together. If you're tax loss harvesting frequently too, it can become quite unruly to keep track of the trade dates that are relevant. So we also don't have to watch the individual movements of stock within a direct index due to the notifications Alpha Theta can send us that, given our specified parameters, they send off to us in an email and let us know that there's a potential tax loss harvesting opportunity there.
That's a really good point, Logan, that you make. It's important to highlight the concept for tax loss harvesting. It seems straightforward, but logistically, especially when managing multiple accounts, when it comes to household portfolios, it can get really complicated and fast. And being able to set precise thresholds and automatically monitor wash sales across the board is game changer, especially when it happens for scalability and compliance. So building on that, what role do you think technology has played in streamlining the execution, and how advisors ensure they'll still stay aligned with their portfolio's objectives while automating these taxware strategies?
Yeah, technology is super critical in creating efficiencies in the management of DI portfolios and execution of tax loss harvesting trades. Traditionally, tax loss harvesting has been done primarily or even exclusively at year end, selling positions with those unrealized losses to offset realized gains you may have accumulated throughout the year. The process of these offsetting trades would then either be moved to cash, or the advisor would have to manually select a security to swap the proceeds into. The problem with leaving it in cash is you miss out on potential market returns for 30 days until the wash sale period expires. And then there's also issues with manually selecting securities as well, because you can potentially increase your tracking error against the index, even if you think the swap is fairly straightforward. Not every stock has an obvious offset either. So think, like traditionally Home Depot and Lowe's would be good swaps for each other. Pepsi and Coke, for example, is another one. And sector ETFs can also be kind of clumsy. So for example, if you're trying to harvest losses from McDonald's and you're trying to use the consumer discretionary ETF, you're inadvertently increasing your exposure to Amazon and Tesla, which are by far the biggest weights there, and not maintaining your exposure to the restaurant industry. It also may not always make the most sense to do the most obvious swap in terms of the broader portfolio. This comes from the overall objective of direct indexing is to minimize tracking error relative to the underlying index, which is determined by cross correlations of stock movements. So for example, it could actually make sense to sell a bank stock for a loss and purchase a defense stock. Why is this? Because the goal is to minimize tracking error against the index. So it could be that the most prudent thing to do is swapping something that doesn't make a lot of sense from the financial industry and into aerospace, like I mentioned. And it's happening because of the constant changes that are underlying at the cross correlation level between individual stocks.
And let's say it's also helping you get closer to that direct index for tracking error. So let's say you don't hold something, but you're harvesting at a loss, and maybe the position you're buying is in the direct index, so it's getting you closer to that direct index, right?
Right. Yeah. An example from last week, we were looking at harvesting loss from a healthcare stock, and it was actually recommending that we buy an energy stock, which kind of caught us off guard at first. But like you said, what's happening within the direct index is ultimately what is kind of determining what direction you want to go with that harvesting trade.
Yeah. And Logan, on top of that, AI has become a major focus within, mainstream and across the industry. Can you discuss a little bit on how Alpha Theta is utilizing and leveraging AI to help support your workflows?
Yeah. So in addition to using AI to help develop the process under the hood of what is Alpha Theta, it's also utilizing AI to search through 10Ks and 10Qs for references to specific themes such as robotics and genomics. And those links can then be used to identify securities that you might want to include or exclude from a portfolio. So say, for example, you have a client that wants an AI tilted S&P 500. AlphaThena is using AI to actually go into those 10Qs and 10Ks and find stocks that have some exposure to the AI boom. And then you could build out a S&P 500 tilted AI index if that is what the client wants. And then also AI, there's something kind of similar to like ChatGPT that AlphaThena offers that can help answer questions about account actions or performance. So if you've got a client meeting coming up and you want to know how many tax loss harvesting trades you've made in an account, that could help answer those questions for you as well and make getting ready for a meeting more seamless.
So that chatbot typically helps give you a high level of what happened on that account, and you can utilize that, like you said, for your meetings coming up.
Right.
Looking for advisors that are considering to use the AlphaThena's platform for the first time, what was your onboarding experience like?
Yeah, like any technology, there was a little bit of a learning curve, but not too much. You just have to learn the various functions of creating indexes and the tax loss harvesting tab and managing accounts and rebalancing them, generating the various different reports that you can pull off of AlphaThena. And then the most important thing to me is just understanding the underlying settings and options that sit kind of underneath the surface of AlphaThena and how that impacts, the notifications you're going to get or what's going to trigger a tax loss harvesting strategy, as we kind of talked about earlier. It does require a little bit of a time commitment for the person that is going to be working with AlphaThena primarily in your RIA. But overall, it's a pretty intuitive system and laid out in an easy way to understand. And the level of service and support we've gotten from AlphaThena has been great. We meet with Carrie almost weekly, and we talk through any questions we may have with the platform, or they may be rolling something out that's new that they want to show us and that we need to kind of get our hands wrapped around. And they're also really good about taking feedback from us there, where if we have something that we think maybe would improve the platform, they're always open to hearing out our opinions.
Yeah, I'm surprised you're not tired of Mohan and I. So just pivoting a little bit, Bruce, I'm going to give you a really hard question here. So we're trying to quantify. How would you quantify the impact of tax loss harvesting? I know there's been quite a bit of research out there trying to measure the potential benefits for tax loss harvesting in terms of real world outcomes and studies that put numbers behind it. Can you help quantify this?
Yeah. First of all, disclaimer, like any discussion of the tax benefit, it's going to vary by the circumstance of the individual investor. What tax bracket are they in? Do they have tax loss carryovers from prior years? Does our current portfolio even have unrealized losses, or is it completely ossified in that all of the positions have sizable unrealized gains?
Right. So it's not a one size fits all type approach. You really need to look at, the client's overall tax picture.
Yeah, that's true. So let's take a look at a sample $1 million portfolio to try to, come up with some kind of intuition behind the numbers of how beneficial this can be. So this chart is data from Vanguard. It shows the cumulative dollar amount harvested over a 10-year period ending in each calendar year. So each of these bars represents the end of a 10-year period and how much of your $1 million portfolio was harvested over that decade. And this is 30 years in total across the entire chart. Now, you can see that the amount that you have harvested, not only for that year, but for the prior decade, does bounce around. And that's going to depend on what's going on in the market and whether it's been a volatile period and an up period, a down period, or both. But broadly, over this 3-decade period, the amount harvestable over $1 million portfolio is about half. It's averaged about $500,000 per 10-year period. Now, let's translate that into actual tax alpha or after-tax benefit. So this is the same 30-year period. It happens to be 92 to 22. Only now we're looking at the tax alpha. That's after-tax performance boost for each of these 10-year periods. And this is, again, from Vanguard. You can see its range from approximately 50 basis points at the low end to 150 basis points or 1.5% in after-tax performance at the high end. So, something like, in general, like a percent in after-tax benefit.
So even in moderate return environments, Bruce, you still get a meaningful tax alpha.
Yeah, that's right. It's unpredictable year to year, but how do you get to that? Well, let's use 100 basis points as the median between these two. So let's take some numbers from the chart before. For $1 million portfolio, let's say over a decade, you've harvested about $500,000. That is to say, you've offset about $500,000 in tax liability for your client over a decade. And let's also assume, that your client is in the 20% capital gains rate. So you've saved your client from paying 20% on $500,000 or about $100,000 in taxes that they're not going to have to pay as a result of that tax loss harvesting over a decade. So that's about $100,000 or about $10,000 in tax savings per year. So $10,000 in after-tax savings over $1 million portfolio is 100 basis points annually, or 1% in after-tax returns. 100 basis points is a lot in annual performance. Compare that to, you're frequently thinking about relative performance. So you're comparing the benchmark to your actual performance, or you're thinking about mutual fund expense ratios. How much are you being charged? Or you're thinking about your advisor fee. How much are you able to charge your client? So that 100 basis points is relevant to all of those things. Now, tax alpha, it is going to vary widely dependent upon the specifics of the investor and the account type. For example, if there aren't any unrealized gains to offset, you can tax loss harvest all you want, but the only benefit you're delivering your client is $3,000 in annual offset against their ordinary income. So that's why I said earlier that younger and smaller accounts may not see the tangible benefits as will other kinds of larger accounts with more embedded gains. So DI isn't for every investor. Overall, I view tax loss harvesting. It's one part of tax-aware investing. It goes alongside actions like gifting appreciated stock or being conscious of asset allocation between taxable and tax-deferred accounts, or doing Roth conversions.
Those are great points. Yeah. Just pivoting a little bit, Logan, let's zoom in now on market conditions. So, given the volatility in the market conditions right now, where volatility has had some sharp peaks, from year to date, are there certain types of volatility with these sharp sell-offs and prolonged downturns where tax loss harvesting might be more effective? I'd love to hear your thoughts and when advisors should be most proactive in these types of environments. Logan, you're on mute.
Thanks for that, Carrie.
Yep.
Obviously we saw some pretty extreme volatility so far in 2025 that peaked out around the beginning of April when Trump announced the Liberation Day tariffs. And that bout of volatility has really only been rivaled by, COVID, the great financial crisis, and the dot-com bust. And periods of increased volatility obviously tend to be times when there are increased opportunities to tax loss harvest. Sharp sell-offs that recover quickly are a good time to realize some losses, but that's when it becomes really important to have an adequate replacement. So then in the event of a sharp turnaround, like we've seen so far off of the bottoms in early April, you're not missing some of that rebound. So if if tax loss harvest NVIDIA, for example, in the beginning of April, and you didn't swap into something that's a lot like it, you're going to miss quite a bit of upside when it bounces back quickly. Now, on the other hand, prolonged downturns are an even more advantageous time for tax loss harvesting strategies. So typically when equities go through bear markets, there's going to be times when the markets are going to bounce off the lows, which can create nimble opportunities to get some harvesting opportunities. And if you're like most investors, you're probably incapable of precisely timing a bottom. And when those prolonged bear markets are taking place, there's going to be times when it's going to rally and then we're going to fall back to the lows. And we saw that in 2022. As you can see there, 91% of the stocks in the S&P 500 had tax loss harvesting opportunities throughout that year. And that's based on a 5% decline from the beginning of year value. But you'll see even in other years, such as 2020, 2021, and the last 2 years, obviously, where there were tax loss harvesting opportunities that were out there, even though the market was broadly higher. So it's not just years where the market struggles or has extreme bouts of volatility, even years like last year where there really aren't many downturns in the market, where there are still going to be some harvesting opportunities at the individual stock level.
Great. And Bruce, just coming back to you, how often, and you guys talked about this a little bit, but how often should you be tax loss harvesting? What's the frequency? I know some sub-advisor firms, tax loss harvest at the end of the year in December or once a quarter. What do you see and what do you recommend?
The year end is kind of the traditional method from an earlier, less technologically able generation because it was very manual. Now, since nobody's going to be able to predict the market's direction day to day, so there's as much art as science in deciding how frequently and when to take losses. The Alphathena software is very flexible, allows us to configure at what level or what loss it alerts us to opportunities to do harvesting. I should also point out the software only suggests the possible times to do tax loss harvesting. It doesn't automatically do it. So the portfolio manager is always in control, as it should be. Portfolio manager has to decide the right interval or frequency to do tax loss harvested. You could either do it at a fixed time interval, such as weekly or monthly. You could decide to do it based on the magnitude of an unrealized loss. After a big market move or in a particular stock that's been under pressure. Keep in mind that performing tax loss harvesting is going to increase your tracking error because you are, taking out a stock that is in the index. You're taking out a component, replacing it with a different stock, at least until day 31 when you're past that wash sale rule. You're also creating a little bit of trading costs, however minimal. So overall, the PM needs to be aware whether an account, what type of account is it? Is an account that their primary interest is a strong objective in maximizing realized losses versus, on the other hand, is it a primary objective towards using direct index mostly to personalize their index, but with a lot less interest or ability even to do tax loss harvesting?
So you mentioned, tracking error, tax impact, and trade costs. Would you say it's a bit of a balancing act on trying to manage? It's more of an art and science to figure out how to manage all three of those, and which one is more important than the other?
Tracking error and tax impact, I do think that's the balancing act right there. Trade costs really should be an afterthought.
That makes sense. Yeah. And Bruce, what are the common misconceptions that advisors, or clients might have about tax loss harvesting that you frequently need to address?
Sure. Two things. First, it's passive. So you understand that direct indexing is not an active stock picking strategy. To minimize that tracking error, to repeat myself, it's an index to the key security selection objective. And then the second thing, clients can really struggle with the idea that taking a loss is beneficial. They can confuse the benefit from tax loss harvesting with the overall beta of the market. Why should I sell a stock when it's down? Isn't that when I want to be buying stocks? Everybody's thinking along that line, as they should be. So the advisor may need to provide some tutoring on how tax loss harvesting should be neutral to the portfolio's market exposure. In other words, you do sell a stock, you take a loss, but then you're replacing it with a stock at the same market level, which, if the index is doing its job, will appreciate approximately the same amount as the stock that was taken out. Here's a recent example, Carrie, is United Health. This stock's been under huge pressure for 6 weeks from, a number of different problems. When do you choose to harvest over that period? How low is low? At a set dollar or percentage loss? And when you have harvested and replaced it with another stock in the index, what are you hoping for the stock over the next 30 days? You want it to trend lower so you can buy it lower? Do you want it to rebound because you've already replaced it with something else? So I'd say that those are the two misconceptions that you need to be confident that your client understands.
Yeah, I think United Health, as you pointed out, that's a good, idiosyncratic risk where you can take a look at it and make a decision off of that, what you want to do. So that's a good example. It's also important, as you mentioned, that there's certain distinctions of what you talked about. So it can be a bit counterintuitive, when you're hoping the market goes down. I can remember in my PM days, I got excited to tax loss harvest as the market came down. When you're thinking, wait, I want the market to go up, not down. So to your point, yeah, it can be a little tricky to explain to clients and advisors, no, in this strategy, you want it to go down. In order to help reduce your client's overall tax liability. But once they understand that and it gets to the point, you can clearly see the tax loss harvesting is a useful and benefit power for taxable outcomes for their returns. And it's a great strategy to use, And at this time, I just want to thank both, Bruce and Logan for your time today. And we're going to open it up to any questions for the audience that they might have on tax loss harvesting or direct indexing.
Carrie, can you see those questions there?
I don't see it. Here we go. We have some questions here. So, Logan, what is an acceptable level of tracking error for direct indexing?
Yeah, the complicated answer is that it depends. There's not one set level that is considered acceptable. It depends on, number one, on the index that you're trying to track and how many securities you have in your direct index. So the S&P 500, for example, at MainStreet, we have 100 stocks in our tracker. Obviously, there's 500 in the S&P 500. So that tracking error comes out to be a little under 100 basis points. So that's what we're deeming to be an acceptable level. But again, like the NASDAQ 100 only has 100 securities. So if you have 50 securities in there to track that index, then you'd expect that tracking error to be a little lower. It also is going to depend on there are differences at the account level that can kind of impact that. So if you've got a smaller account and you've got 200 securities in your direct index, you're probably not going to be able to allocate to all 200 securities. So that's going to increase your tracking error, as opposed to a bigger account that's going to be able to have all of the securities in it.
Very good points. I think we've got one more, Bruce. Are there any changes expected in the tax code that will change the value for tax loss harvesting?
Good question. Had the Democrats serve in Congress, there would have been a lot more to discuss on upcoming changes to tax rates. And keep in mind generally that the higher the tax rate, the more valuable the tax alpha or the tax loss harvesting opportunity is. Under the current bill winding its way through Congress, the one big beautiful bill, there are no changes to the capital gains rates proposed. However, there are changes to the brackets, which will the bracket amount that pushes you into what rate. So I would say overall relatively minor changes here, and presuming this bill goes through, that's probably going to mean, at least for the next couple of years, a fairly stable capital gains tax rate for us to work with in tax loss harvesting.
Great. And we've got one more. Is there a minimal capital required for a direct index account, and which accounts are more suitable? And I think we've touched upon this a little bit. So, Bruce, do you want to take that one?
Minimum capital, you mean account size? Is that what you're getting at?
Yeah, I think they mean account size.
Yeah.
Yeah.
That is going to vary by the investment shop, the investment advisor at Main Street. We elected to go with a $500,000 account minimum. I've seen others lower. And the problem is, as you can imagine, like let's say you just threw the doors open entirely and said there's no minimum, and there's a minimum of $100,000. Number one, it becomes very difficult to build an index in that. You're going to have a lot of little teeny tiny positions. And number two, it's likely that the whole dollar amount of the benefit is rather small. It's kind of a question of like, if you had a really big account, you know that you're going to be able to afford all of the components that is within that index, and you're going to be able to benefit more. On the other hand, not everybody has $1 million or $2 million to put into direct indexing. So it's a trade-off, but we figure $500,000 is the right place to be.
Yeah. And right now, I just want to thank everybody for attending our webinar. And, Bruce and Logan, again, thank you for your expertise. And MainStreet Advisors, thank you for joining us and hosting this webinar with us.
Glad to be here. Thank you for the chance.
Thanks, Gary.
Thanks, guys.